Let's get some more perspective on what's happening today and beyond with Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel and BMO Private Wealth. Thanks so much for joining us today.
Good to be back, Jacqueline.
So let's talk about Canadian markets a bit, because you said that the outlook is a bit cloudy right now for Canadian equities. What are you seeing that's sort of making things muddy?
Yeah, it's the macro backdrop really that is cloudy. When you have central banks on both sides of the board, around the world really, saying they're data dependent, and the data having such wide swings at the moment, still these lingering impacts of the pandemic and the war in Ukraine and supply chain issues, still these are all reverberating through the system. And so it's that data dependency that has markets hanging off of every data point. If it's a little bit better, they rush to the one side of the story. If it's a little bit worse, they rush to the other side. And we saw that in January and February.
Yeah.
You put a cyclical market like Canada against that backdrop, what's happening with oil prices, and certainly lots of moving parts there. And it just makes for a great deal of volatility, and the narrative seems to be flip-flopping between things are going to be better to things are going to be worse.
Yeah, it's interesting. I mean, it makes life here interesting when there is such a reaction either way, Brent, but would make it really difficult from an investor's perspective, from your perspective, I'm sure, to be trying to navigate through this.
Yeah, we have a mantra that, 1 month, one data point does not make a trend. And because we have seen things move in one direction and then turn around and move in the other direction, we have typical seasonality quirks that many of your guests have talked about, over the past couple of weeks, coursing through this data. We're in the squishy zone here. We've just finished earnings season, so the market doesn't have that lifeblood to latch on to. And as you noted, we've got a number of data points that are coming out over the next week to 10 days that are certainly important, and we want to see a string of these, and we're just going to have to be patient and take some time to see whether this trend has stalled or if some of the good news that we saw in January gets us back on track.
It's interesting, I mean, to try to be patient in these times when markets can kind of run away with things, as you were already outlining. But when you think about January and the gains we saw in January, and then February, a bit of a reversal, you were expecting a little bit of that to happen because January you thought was a bit of an overshoot, but now February, do you think that was overshooting to the underside?
Yeah, I think there's some of that in there. We had markets want to rush to the end game. And so when January's data brought out immaculate disinflation and the soft landing came back onto the table, stock markets in particular started to race ahead. And we certainly felt that we had put in 2/3 of what we have penciled in for the year, pretty much came in the first 3 to 4 weeks of the year. And that was a bit ahead and well over our skis. On the fixed income side, also had a bit of a raised eyebrow to how low yields had gotten in January on the back of this immaculate disinflation and central bankers coming out, potentially not outright saying, well, Bank of Canada saying they're pausing, but the Fed sort of dialing it down. Disinflation was the language that was used. Thank you. Yes. And then February, that all gets chucked out the window with a couple of bad prints, no doubt. 1 month does not make a trend. There are still lots of encouraging data points underneath the surface. We need to look at, obviously, inflation numbers are important. Behind that are the wage numbers, so we'll get some indication of that this week. The employment numbers were the ones that were the big shock. And there's a lot of head scratching by economists, botched forecasts for sure. But it's just the environment that we're in the post-pandemic environment, that these data numbers are swinging so wildly. Not like we normally typically see these massive swings in the macro data.
Yeah, we've got a couple of graphs that are touching on some of the data points that you're watching. Productivity in the U.S. is one of them. Maybe we can bring that one up. But what is it about this that you're looking at that's important right now?
Yeah, so this is a very long history here. If you look at the scale on the bottom, we're going back to the 1950s. We talk about these types of economic data as being aircraft carrier or battleship type data. They're hard to move. And yet at the very tail end there, you see this blip up. And in a data set that is typically quite stable like this, that's a significant move. And so the concern that we see today is everybody concerned about productivity being very languishing. The year-over-year numbers are negative. And it's because we've got that blip in there. And so they are, just on a statistical basis, going to improve. It's a bit like inflation. We're lapping these very tough numbers. We're lapping some of these productivity numbers. The reason that's important is the nexus between wage growth and inflation. We can have, some wage growth and inflation can still come down. Productivity is the magic key that fixes that and feeds all mouths.
Are you encouraged by that? Do you think that that's going to be the case? Yeah.
Yeah, I'm encouraged by a number of these data points that if we fast forward 6 months from now, 8 months from now, and we will have, 6 or 8 months more of information, that some of the talk that's coming out of central bankers about the amount that they're going to have to raise rates, particularly in the U.S., but you're hearing it in Europe as well now, the length of time they're going to have to keep them high. I think the story is going to be very different in 6 or 8 months after we get some of this data that will start to settle back down into its long-term trends that are not frightening or scary for central banks in terms of inflation and wage growth. And productivity is at the heart of that.
Let's take a look at one more. Retail sales for the U.S., right? That you're watching?
The Canadian numbers were quite similar.
Yeah.
And again, these are battleship numbers. They go in long trends, and you can see we've had this huge disruption from the post-pandemic period. So retail sales in the U.S., this is what spawns that mantra, never count out the U.S. consumer, because they're so reliable. They spend 4 to 5% on a nominal basis growth year after year after year. We're now at 6 and 8% growth in retail sales. Some of that's inflation, though. This is a nominal number. But at the tail end of that, deep dive in December, that had people sparking the softer landing, right? Yep. And then a big rebound in January, and everyone's saying, well, the Fed's going to have to do more. You straight line across those two data points, and it's a pretty smooth, trend-like environment. You have to really step back from the minutia of each data point and say, where is the trend taking us?